one. All right, guys, welcome to our weekly team production meeting. Today, we are blessed to be able to be with Manny and Russ and his team, and they're going to share some really important tax strategies with us and how we can utilize them really to, I don't know, we'll see, right? Hopefully make more money, save more money on taxes, stuff like that. So, Russ, or if Manny, if you want to introduce your partner, Russ, and then we'll go.
Absolutely. Jeff, thank you so much for this opportunity, Jeff. We've known each other for probably for what, 8 years already, sir. We've from the beginning when I was in the other building over there in Galleria. So, and we've been growing a lot, learning a lot more information. What I'd like to do is present my business partner here. I've been working with him for the past 8 years as well. And he has about 30 years in this industry. The knowledge that he has, he's able to help out a lot of people. He's always seeking a lot of knowledge and more information to be able to help our clients save more money. Because at the end of the day, what we want to do is what? Save more money for ourselves and quit sharing it with the government, right? And better ways to find the strategies to find that will help you mitigate taxes versus depreciation, all these different things that you got to just kick the can down the road, or different strategies that you utilize. When we talk to different CPAs, Russ has been able to even show them more things that will help them and their clients even build more wealth for themselves. So I want to just take the time to Russ, thank you for taking the time here as well and being able to share this information with all of us. And take the floor, brother.
Well, thank you, Manny. Thank you for the introduction, Jeff. It's a pleasure to be on. So I like to do things more in a conversation mode more than presentation mode, Jeff. So I'm gonna ask you probably treat you like a client. We're probably better off. I mean, because I can have some interaction that way and kind of figure out the way we do this. Because just to let you understand, so the name of our organization is Best Financial Partners, and there's a reason that we choose the name and that design, because we truly create a partnership with our team, with everybody we work with. All right, that's the mentality. Nobody's in this alone. We're in this so that we're against the IRS. That's the mentality. Okay, so it's us against them. All right, and as a company, we have a mission that we're trying to grow to $10 billion in taxes saved from the IRS.
Wow,
Okay. That's a pretty good goal.
it's a great
Okay.
goal.
And we're moving forward. We're moving forward on a daily basis with the process. And it's not by doing anything incorrectly. It's by using the laws that are on the books that they don't, and honestly, half of the IRS agents don't even understand what the laws are. So when we get into this type of situation, it's about how can we go out there? We all work, we sacrifice. We sacrifice so that we're trying to create things for our family, typically. And that's the structure. So my main focus in business and our mission motto statement is to leave people better than we found them. Okay. And that's done primarily by education. I mean, it holds true for your business as well. You're out there in the real estate world, you're educating your clients to what's available, what's the options, what they should do, what they shouldn't do. There's checks and balances, there's qualifications, there's all these different people that have this. You got all these layers, right? You're going from getting pre-approval to getting into the documentation, to going into the titles, all the things, the checks and balances that are put in process. And at the end of the day, a lot of those are a money grab. And at the end, we all know that. Yeah, everyone's getting paid for something. Well, we all live based on currency that flows in and what flows out. The key is how much. It's not what you make, it's what you keep. Right? And that's the process. So, I mean, I know a lot of people, one of the first questions I'll ask Jeff when I talk to him, especially a business owner, and I'll ask you this question is, are you happy with the amount of money you pay in taxes?
No.
No. And I usually get one of two answers when I ask that question. And no was usually the most common one. Or I get, yeah, well, I don't pay a lot in taxes. And my response right away is, so you must invest in real estate. Okay. How applicable is that to this particular environment that we're in today? All right. I'm dealing with all real estate professionals. So everybody that's out there today that's making money, they think they're going to become a real estate tycoon, right? So they're going to go out there and because someone said they should buy a fix and flip or they should buy a rental property, they should do this. But they don't look at the other side of what the responsibilities are. Okay. The person is going to go buy one or two homes as an investment property. They'll go in half cocked and they come in and they're going to put down 50% because they have the money sitting in the bank, or they're going to put the whole amount down on the house. And I sit there when they tell me those conversations and the hair on the back of my neck goes up. I'm like, do you understand what you're doing? it's going to take you 14 years to break even.
Mm.
And they don't understand the dynamics. So they have to understand the concept of leverage. So we spend most of our time, I'd say 80% of our time is educating. Okay. Showing people what they need to do, how to do it. All right. Is the other side of it. And then the implementation is the simple part. Okay. That's really what we get into. So when we talk about mitigating, and I don't talk about deferring, and there's a big difference because in the real estate world, you guys know the 1031, okay? Especially in commercial, the 1031 is the holy grail. Oh, I'm going to 1031 it. I'm not going to pay capital gains. That's the reason people are doing 1031s. They're doing it so they don't have to pay capital gains tax. So then you get the people that are a little bit more educated or a little bit more involved because they have more value. They're going to say, well, I'm going to go into a deferred sales trust, okay? Or I'm going to go into a Delaware statutory trust. So they're going one of the two things, and now they can take that money that they had instead of reinvesting it into a piece of real estate. Now they can go put it into a brokerage account or some other way to invest their money. And there's a lot of cost prohibitiveness on that. And also, a deferred sales trust is a deferral mechanism. Okay, so you're kicking the can down the road. Now, can you defer into perpetuity? Technically, yes, you can. Okay. The problem is that the level of structure, meaning that if you're deferring in the perpetuity, that means that your family, your heirs, is going to have to continue doing what you did. And at the end of the day, generations usually don't replicate what they did before, not in today's world. Okay. Most people are looking to cash out and they're looking to leave. I can tell you, client after client after client I've spoken to through the years, when I ask them and they've amassed this large portfolio of real estate, and they're sitting there and they're thinking they're going to give this to their kids. And when I get the kids on the phone and them at the same time, and I ask them what they would rather have, would you rather have this estate, this whole portfolio your parents have created, or would you rather have the cash? And in less than 5 seconds is, I want the cash. Okay. They don't want to deal with it because they dealt with it growing up. Right? They dealt with all the aggravation, the arguments, the frustration that all these people went through in dealing with people that were tenants or landlords of homes. Okay. Because real estate is a tremendous wealth builder, 100%. Okay. It is a tremendous piece. The key is how can we sit there and mitigate rather than just kick the can down the road? So one of the strategies that we implement with our clients, we have a program, and a lot of times that we'll use this, is called an LLC with charitable intent. Have you ever heard of that, Jeff?
An LLC, what? What was that last part?
An LLC with charitable intent.
Never heard of that.
Okay. So I'm going to share with you just a presentation structure just to kind of give you an idea of what it looks like. Okay. But this is designed for people that, and this on the heading here, it says high net worth but high net worth becomes ultra high net worth if you're leaving generational wealth. So again, we're trying to mitigate taxes. So by mitigating taxes, what ends up happening is we put ourselves into a control position, because if you're going out there, we'll use a piece of real estate. Okay, let's use a commercial piece of real estate, Jeff, just to keep it for simple purposes.
Yeah.
So you got a guy who's got a building that's worth $4 million. Okay, he sells that $4 million property, and his cost basis on it is $1 million because he's depreciated everything else. Okay, so now he's got a $3 million capital gain. All right, now I know you're familiar with capital gains and how the structure works, but typically, just to keep the math simple, on a $3 million capital gain, he's going to face a 20% capital gains tax. Okay, that's just federal level. That doesn't include state, so we'll just keep it simple. So 20% on $3 million is how much, Jeff?
Oh man, pop quiz. 10% is going to be 300, so 600K.
$600,000. So now if you sold that building for $4 million, you still owed $1 million. These are your cost basis on it. So now, and then you got to pay $600,000 in taxes. Most people aren't too happy. That's why they're trying to do a 1031, right?
Right.
Because they don't want to pay that $600,000 capital gains. That's a problem. I can put that $600,000 into a building. Well, and as you know, 1031s are like for like or more, okay? And you have to declare, all right? And if you don't declare and close within a period of 5 months, that becomes a problem, okay? And now what's ended up happening is that you're buying overvalued properties a lot of times because you're trying to mitigate the capital gains. So if you think about it, if I'm mitigating capital gains, but I'm paying $500,000 more for that building than I need to pay, how much money did I actually save?
Right.
Not a lot. Okay. So let's use that same example and let me see if this makes better sense for you. We got the same $4 million building, $1 million cost basis, $3 million. If you had one of these platforms, the LLC with charitable intent, and we moved your ownership interest into the LLC prior to your closing, now what would happen is now you still go through the closing, you still get the same $4 million aspect, but the difference is on that 300 or that $3 million gain inside the LLC, your effective tax rate is you're only being taxed on 2% on that $3 million.
2%?
2%. So now 2% on $3 million is how much?
60
Let me tell
grand?
you to bring a calculator. How much?
60 grand?
60 grand. So now you have a $60,000 gain that you would be subject to 20% on. Okay. So that means you're going to pay $12,000 in tax. Now, let me ask you a question, Jeff. Would you rather pay $12,000 in tax or $600,000?
Let's go with 12.
12,000. Yeah, how about that? I mean, that's surprising you picked that answer.
Yeah.
Okay. The difference is that most people don't know there's options out there. Now, if you did this situation, we moved the money into the LLC because through the transaction, now you have $4 million effectively sitting in this LLC, $4 million in cash. Okay. You have complete access to that $4 million to do whatever you want with that money. Doesn't have to go into real estate. You can go buy gold with it. You can go buy crypto. You can go on a vacation around the world. I don't care what happens. I'm simplifying it for the process to kind of give you understanding. But the concept is you don't lose control. So this is kind of giving you a reference point of here's just how it looks. Okay. So the way we create it when we set up an LLC in this structure is that an LLC, everybody knows what an LLC is. But what we do is we create it as a partnership where you take 2% Class A shares. So you're controlling member, full operating, full voting rates. And then we partner you with a 501c3 or DAF, a donor advised fund. Okay. That's it. They own 98%. And then you know what happens when you have a charitable entity is they don't pay taxes. So that's why I'm able to, you only are responsible for 2% in your particular portion because you're only a 2% owner in the LLC. However, you have 100% control of all the money. Okay. Now, the technical aspect of it is that when you put the money into the LLC, it is an irrevocable gift to the charity. Okay. So I'm not telling you to give your money away. You're not giving it away today. You have full access to it because the LLC will last for 90 years. Okay. So you have full access and control of this money for your lifetime and then your children's lifetime. And because it's an LLC, you're also getting 100% estate protection and asset protection. Okay. And now again, you have full control to do what you want to do with that money moving forward. Now, that 2% is exciting based on the tax growth, but think about this. Now you have $4 million in the account. That $4 million, let's say you put it to work for yourself in the market. Okay. And let's say you only got a 10% return. Okay. What's 10% on $4 million, Jeff?
$400K.
$400,000. In your standard tax bracket, okay, if you're making the money you're in, you're probably in a 35% tax bracket. So if I made you $400,000 inside the LLC, you're like, well, God, I just set myself up for another $135,000 in taxes. So I didn't really make 400,000. I only made 265,000 because it's not what you make, it's what you keep, right?
Right.
All right. So I increased your income. Well, if it was made inside the LLC, that 400,000, same rule applies. You only pay a tax on 2% of the growth. So now you're paying tax on $8,000 in your current tax bracket at 35%, 35% of $8,000. Okay. You're spending about $2,600 in taxes. What would you rather spend? 2,600 or 135,000?
Let's do 2,600 there.
Do you see a pattern I'm developing here for you, Jeff? Okay. Yeah. Now this continues on and on and on. So it's like if you know what a Roth, have you ever heard of the concept of a Roth IRA? Okay. Well, the problem is you make too much money to put money into a Roth. Okay, in your situation. However, this is like a Roth on steroids because I can grow money and only be taxed on 2% of the growth for the rest of my life. Show me another plan in the United States that offers that kind of coverage. There isn't one. Okay. So this is the phonetics. This is kind of a flow chart just to kind of give you understanding. But the way it works is so we set up the process. We create an LLC. The LLC is formed, takes about 3 to 4 weeks to set up the process. We have you assigned to one of the charities. We have 6 national charities that we work with and 1 donor advised fund. We set up the process. We get it taken care of for you. You basically then are open up a checkbook inside of the business LLC's name, okay? Put it in usually in the same bank that you already work with, right? So if you work with, what bank do you deal with, Jeff?
Chase and IBC.
So Chase. So if you have a personal account in Chase, I would have you open up the LLC account in Chase as well. And the reason being is that you deposit the money into the LLC, okay? That goes in there, but when you want to take money out, you're going to take money out as a disbursement to you, as a loan, okay? Because you're taking out as a loan, it's not constituted as income, all right? Now, this is a legal document, it's a legal structure, so what ends up happening is that the money that you take a loan out as a document is created, and it's assigned what they call as the AFR, which is the adjusted family rate, which is set by the IRS. Okay, so there is interest on the loan. However, the way that we structure it is you don't have to pay the interest back yourself directly, because what we do is we collateralize the money that you take out of the LLC account. We collateralize it with permanent life insurance, and we do a swap. Okay, so if your case and your design, let's say we were talking about this $4 million entity or your income structure, we would have gone and set up, let's say we set up an $8 million or $10 million permanent life insurance policy. And let's just say, for all intents and purposes, that $10 million life insurance policy on you costs $150,000 a year for 10 years. Okay. Now you've already seen the savings I showed you just on the first transaction. Okay. I saved you almost 500 some odd $1,000. So the money that we're saving in taxes is more than enough to take care of this cost basis that's on this process. Okay. What we're doing basically is we're reverse engineering the whole entire concept. So instead of what you're sending out to the IRS, you don't have to send them. Okay. And this is just on a transaction. Okay. But this doesn't just apply to transactions. This also applies to people that make money in other business, not necessarily real estate. Okay. If you're making money in a generated business, now you make money, yours is a real estate business among one of the businesses you have, but you generate revenue. And most people in business usually have an LLC or an S Corp. Larger people would have a C Corp, and you can have this involved in all of those businesses as well. But this is also applicable for someone who's a high W-2 income earner. Because with high W-2 income over $300,000, I can show you a way I can adjust your AGI, your adjusted gross income, by up to 60% using this platform. So I'll give you an example. I have a client who is a doctor, okay? He's a radiologist, okay? He makes $800,000 a year. He's a single dad. He has 2 children in this particular case. He's 38 years old, all right? Makes $800,000 in W-2 income. He's in the highest tax bracket. He lives in a non-income tax state, so he's only paying federal currently at 37%, okay? So less his deductions, so he's paying tax because he's got 2 children, mind you. He has an AGI of about $750,000. So he's paying $277,000 is being withheld from his taxes every year currently. Inside this platform, he set up the platform, and then what he did is every 2 weeks he gets paid. So every 2 weeks he would put one into his regular account, and then he would put the other check into this CLC account. He was just doing it because he was creating a contribution to the LLC. By doing that process, less deductions and discounting, basically what ended up happening in that whole scope of things is I was able to reduce his income from $750,000 of his adjusted gross income down to $300,000 in adjusted gross income because of the contribution level. Now, what did that do for him? So by me changing his income, his adjusted gross income down to $300,000, I lowered his tax bracket. He's no longer in the 37% tax bracket. He ended up being in the 30% tax bracket. So now his tax liability was $90,000. But he paid in $277,000, Jeff. So guess what's going to happen? He's going to get back a refund for $180,000 back from the IRS.
Is there a max contribution?
There is no max contribution. Now, let me ask you a question, Jeff. If I found you $180,000 that's coming back from the IRS, do you think you'd be pretty happy with me?
Be pretty happy.
When was the last time your accountant got you money like that back from the IRS?
I usually pay that.
Yeah, you haven't got it yet, right? You're still waiting for that phone call.
Yeah, it's
right?
coming. It's coming.
Yeah, it's years. Yeah, so was yeah, so was Christmas. But not that kind of Christmas. You know what I'm saying? It's the process. It's understanding the design. See, a lot of people try to complicate things. This doesn't. If you see it here, this is as difficult as it gets. It's an LLC, and LLCs are designed for profit. 501c3s are exempt. Your 2% Class A shares, keep it simple. The CLSC or the charity owns 98% on paper. Okay. You have all the voting rights, you have all control, you have everything. They have no access to anything until the day, not when you die, because remember, the LLC will last for 90 years. So even after you pass away, this is transferable to your family. You set it up, they continue moving on. Okay. The money stays inside the LLC. You can loan the money out, borrow the money at your discretion. You don't have to pay it back. If you pay it back, then the loan gets wiped out. But if you don't pay it back, the collateral, which is what we have as far as the swap with the life insurance, keeps you fully covered. So this way you never disinherit your family and you never disinherit the charity. Okay. Now, here's the ramification of this process, and this is what I really love. You got to use the entire money and your family got to use the entire amount of money that you've put into this account for your entire life without any restrictions. But at the end of the day, because we utilize the platform to sit there and give you coverage, when you're no longer here and the charity basically in this LLC is dissolved, what ends up happening is now the charity gets everything that you put into that as far as a dollar value, and so did your family. So you basically doubled your dollar bill every time you put it in here because they're going to get the gift and they're going to let you use the money the entire life that you have. Okay. So again, topical, but here's the main thing that you're really trying to do. All right. We can put the IRS donations on your personal tax returns. The tax thinkable goes down to 2%, not just on the initial transfer. Okay. But on any gain going from there. Okay. We can reduce your state taxable income down to 0%. Because federal is different than state. We file it differently, okay? Home capital gain sales are taken down to 2%. Home sale capital gains down to 2% because you know there's an exclusion, okay? $250,000 if it's your primary home per person, as long as you've lived there for 2 years or more. Now, I'm sure you sell some homes that are worth over $500,000, don't you, Jeff?
Yeah, still a few.
Million, 2 million, 5 million, 10 million, right? You got these bigger homes. These people got capital gains on 8 million, $9 million. All right. That's a problem.
Yeah.
Okay. People that work for publicly traded companies, really a different conversation, but people that work for publicly traded companies will get stock. And they're called RSUs, restrictive stock units. Problem is when you work for a publicly traded company, they give them to you. You get taxed on them the year that you're given those RSUs. So what ends up happening is you have a piece of paper, and let's say the company gave you 150,000 in RSUs. You have a tax liability of like getting another $150,000 in income. You had to pay the tax on that.
Even if you don't
Inside
cash it in?
it's it because you get them on, it's declared. It's like you're getting a 1099 for
Got
that. It's a distribution to you. And so you have to pay the tax accordingly as it's income. With this platform, I can eliminate that. Okay. And not just on the front side, but on the back side where the capital gain is, because a lot of times on a publicly traded company, they may give you stock and it was worth $50, but by the time it matures, it could be worth $300, $400. That's all of the capital gain. Inside this platform, the LLC eats the gain. So you don't have to pay any tax on the gain either. Okay. We keep it very, very simple. The life insurance, the permanent life insurance is something that's it's pennies on the dollar when you're looking at swap collateral. Okay. And you can put anything of value into this particular type of platform. You have real estate, you have artwork, you have crypto. Crypto is a huge thing that a lot of people are dealing with. And as you know, crypto, when you're dealing with it, you could either be dealing with short-term or long-term gains. Now, with the way the crypto markets are blowing up, when you look at it, someone could put $100,000 in, next thing their portfolio is worth $3 million. Well, now they got a capital gain on $2.9 million. Okay. So how much money did you actually make if you got a capital gain that's being taxed as ordinary income?
Right.
All right. So it's a process. Now, as I talked about before, we talk about legacy, right? Because legacy is very, very important to me. It's what I do for. But we start talking about creating generational wealth because you can work and sacrifice and do everything that you need to do. The problem is is that if you don't prepare yourself, what a lot of people don't realize is that estate tax is a real issue. Okay. Do you know what estate tax is, Jeff?
I do not.
You do not. So right now, that if you were to pass away and you passed away, what's going to happen is everything technically is most likely going to transfer to your spouse. Okay.
Mm.
There is no estate tax due. But let's say, God forbid, let's paint a very bleak picture, and I don't like to say this, but it's reality. Let's say you and your wife went out on a date one night and someone had the kids, right? And for some reason, on the way home that night, there was bad weather, something happened, you guys didn't make it home.
Mm-hmm.
Now, all of a sudden, if your estate is worth, let's say, $10 million today, you don't have an estate tax issue because right now in the United States, it's $12.92 million exempt per person. So right now, between you and your wife, you have a $26 million exemption. Okay. But here's what happens as of January 2026. That changes to $5 million a person.
Hmm.
So now your estate capacity is $10,000. Now that's provided you both passed away at the same time.
Right.
All right. Because let's say that you passed away. All right. And you passed away because of the accident on Friday, but your wife didn't pass away until Sunday.
Mm-hmm.
Technically, that's two separate dates. So you lose the exemption. So now she inherits it. She only is down to one exemption.
Is that how that works?
That's how it works.
Yes.
And then now, if your estate was worth $10 million or more,
Yeah.
okay, and there was a $5 million exclusion after 2026, and that's what it's going down to in 2026 is $5 million. The anticipation is it's going back down even further to $1 to $2 million because the government's anxious to grab the taxes. But here's the stinger. Let's say your estate was worth $10 million. It was just your wife and had a $5 million exemption. It's 40% estate tax right off the top on that additional $5 million. Do not pass go. The government says, give me the $2 million. And here's the best part. If you can't pay the $2 million because you have $2 million in cash, they say, no problem. We'll take your estate. We'll just start selling some of your property and we'll get our $2 million. And they don't care if they sell it for $2 million, $2 million and 10 cents. They could care less. As long as they get the money they're owed, then they're made whole. And if there's anything left, then you get the difference. Okay. See, a lot of people, Jeff, are like you. When I ask that question, they don't understand what estate tax is because you're like, listen, I'm young. I don't got to worry about that.
All right.
Okay. Well, let me ask you this simple question, Jeff. How many people did you come up with, go to school with that aren't here anymore?
Mm-hmm.
Okay. Maybe, hopefully it's not a lot. All right. But it's a few, and it's a few too many because there's no guarantees for tomorrow. So what we try to do when we talk to people, of course, I want to sit there and I want to show people that there's ways that I can help mitigate taxes. There's ways I can help them plan, but it's not just about saving you taxes. That's just part of the conversation that we have. Because if I'm able to sit there in that scenario I gave you, that I said, okay, here's an example. I got you back $180,000 as a tax refund. That's found money, Jeff.
Mm-hmm.
Okay, because you had sent it to the IRS, it's gone. All right. I found you $180,000. So now I'm going to come back and I say, Jeff, we found you $180,000. Let me show you how to put that $180,000 that you found underneath the mattress. Let me show you how to put that into play for you and your family to help you create a stronger generational wealth plan and help you grow money tax-free moving forward. So I can get you a tax-free distribution in the future so it doesn't count as revenue. So I'm going to help reduce your income tax criteria. I'm also going to help you reduce your Medicare tax liability. So everything is about planning for the future using the vehicles that we have in place today. Okay. So I just wanted to show you this piece here and then I'll take questions.
Yeah.
This is an example. So this is for an example of showing people without the LLC in place, and here's one with it. Okay. So the taxpayer in this particular case owed $193,000, right? Because that's what their taxes were in this particular dynamic. They had the state of 69,000, so they owed a total of 263 grand in this dynamic. By having the LLC in place, they donated money, the 263, into the LLC, and then it's a donation. But again, they donated in, but they have access to it. Now, because of that, they ended up receiving, because they got a 60% reduction, the taxpayer received $158,000 in refund check back to them. They retained the 263, And so the taxpayer cash and asset total return is 421. Which column do you think you'd rather be in, Jeff?
This I can't show you, but I wish I had a pointer.
You wish you had a pointer?
I could show you. Yeah, taxpayer cash asset return 421. I think
Yep.
I know you're not asking questions yet, but I feel like I'm missing something here. Um, how much is this? Is this like a monthly thing that you pay into, or um
Okay,
like I was,
no, it's a great question. All right, so when we set up this platform, okay, so the initial platform that we set up it's a one-time charge for the LLC creation, okay, and it's a $30,000 charge that we charge. It's a one-time fee,
Mhm.
okay. The whole creation is created. The only thing that you really need to do at that particular point is go open up your bank account with the
Mhm.
EIN that's been assigned to your LLC. Very simple process. You know how to do that, okay. Now, the CPA firm that handles this process, what'll happen is there is an annual fee. And then in
Mhm.
the annual fee, what they do is they do a full forensic audit every year on the entire LLC transaction. They will also, for that fee, will also take care of your personal and your business return. Okay, inside that. So if you have a CPA, you can continue using your CPA and we'll send them documents if necessary. But if you just have a CPA that's really not giving you tax strategy or planning, you can also incorporate that. The fee is the same. It doesn't make a difference. The annual fee is $10,000. Okay, that includes the full preparation and operation of this particular piece. That's your setup cost. That's your annual maintenance cost.
Mhm.
Now, there is because this is, remember I said charitable intent. There
Right.
is a fee structure because in order to keep it compliant with the IRS, there has to be a charitable contribution on an annual basis. Because remember, this charity is not getting this money for up to 90 years. Okay. They carry it on their balance sheet. So that's what's beneficial to them. So they carry it on the balance sheet. They can get grants and all kinds of stuff because of it. But there's charitable intent. And the way the charitable intent is, it's either 5% of the growth in the LLC of the growth or $1,500, whichever one is greater. So in that example where we had $4 million in it and grew $400,000, you would
Mhm.
have a 5% contribution on that. Okay, so you would have to send in the charity $20,000 on the growth. Okay, does that make sense?
It does not. Uh,
Okay.
5% that I'm sending in to charity, basically send that to myself.
No, no, not a charitable intent. So remember, your partners with a charity. You're gonna have the
Yeah.
Class B shares are gonna be an actual 501(c)(3).
Right.
Okay. So every year after the forensic audit is done, you're
Mhm.
going, and let's say it was $400,000 in growth, it's a 5% contribution to that charity.
Got
So
it.
if you made 400,000 in the LLC, you would
Mm.
have to take 5% of that, which is 20 grand, and send it to the charity. So you would
Mm.
take a disbursement out and send them $20,000. That's it. Okay. Whatever you do with the rest of the money is your
Yeah.
choice, but you still have $400,000 in the account, less the 20. So now you got 380,000 in the account.
Yeah. Got it.
Okay. From the growth.
Got
Okay.
it.
So that's all that is. So the charitable intent is what keeps it in compliance with the IRS.
Mhm.
All right. Because if you didn't give them anything until the end of the game, that's a tax shelter. IRS does not look forward to that.
Right.
Okay. So we keep it very, very simple. So just to recap, it's $30,000 to set it up. It's $10,000 to operate on an annual basis. And then a 5% charitable intent has to
Mm.
be given on an annual basis. Now, the other cost that's involved in this is the insurance element, because in order to have the collateral in place, there's going to be a cost of insurance. And that's going to vary based on the size of the plan, what the person's dynamic is, and we can have the insurance not necessarily on you. So if we set this up, Jeff, in your case, you're young, so we could still set it up in you, but we could put it on someone else in your family. As
Mhm.
long as the collateral is in place, it doesn't have to be on your life specifically.
Mm.
So we may have some people that are uninsurable, they're too old, whatever the situation is. There's ways around that we can make that work for you. Okay. But that's the cost basis that's on this, but the tax savings is astronomical.
Yeah. Yeah.
Money we're recapturing is life-changing because we can do so much more with that money once we get it back from the IRS or keep from sending to the IRS. Okay, because to me, I don't hate to send money to the IRS and give them a no interest loan and then get a large refund. So
Mm.
after the first year that we implement this for you and we know what kind of tax savings we would be talking about, I'm going to show you how to reduce your taxes. You're going to probably stop eliminating paying quarterly estimates or whatever's going on as well, because there's no reason to give them your money because they don't have to get it. but this all becomes part of the strategy. And this is just one of the first strategies that we talk about inside your dynamic, because we have a lot of options that we can work with. Okay. Now, I will tell you, for your group inside of this platform, that price that I gave you is a national price. One thing that we're willing to do is that we're willing to discount for your group. Instead of the $30,000 annual setup fee, we're going to discount it to $25,000.
Okay.
Okay. And on the annual fee, instead of $10,000, we can't reduce it a lot, but we're going to change it to $9,000. So anyone in your group that sees this, that comes through your link structure or whatever's going on, will definitely do that for you. Okay.
Great.
And that's the process. So listen, if we can help save some money, we do that. That's kind of what it is. But what we're really trying to do with this, Jeff, is really open up a conversation so we can get more into a planning and strategizing session for the individual and their family and their business specifically.
Right.
Because we talked about real estate, but this could be used for businesses, okay? Because if someone's selling a business, as you know, you're dealing with the real estate component when someone's selling a business a lot of times, but that person may be selling a business for $20 million. They got a huge capital gains problem, okay? So this can be used. There is no really exceptions for this. I mean, our benchmarks, people that make more than $300,000 a year in income, W-2, people that own businesses making $300,000 to $500,000 a year minimum, people in real estate especially, okay, and people in the tech space, okay. So with anyone who's an independent business owner and structure and things like that, this type of platform specifically works. And then we get into the legacy structure and planning to make sure that the person protects themselves against estate taxes, gives themselves asset protection. We can talk about trust and protections based on the person's dynamic of what's going on. I understand, Jeff, that you and your family have a special type of trust that you've created.
Yeah.
Because you're fortuitous in understanding that you needed to do something to protect everything you worked for, to let someone take it. And so we go through the education process with each individual. We do a very holistic approach into their dynamic, into their family situation, and we break it down to see what's applicable. And then we give them vehicles that we can show them that can benefit their family moving forward, cover their assets, cover their estates, and cover their family so that they're protected, not just in death, but in life, and taken care of and keeping what they've worked and sacrificed for so much.
Well, that's great, man. A lot of information for sure. I want to open up, see if anybody had any questions. They can either just open up their mic and they can ask a question, or they can type it in the chat. And this is how they reach you. That's what I want to get to, Russ.
Yes.
That's how they can reach you there, right? So
That's
it's
correct. Yeah,
bestfinancialpartners.com and then Russ at bestfp.net. And
yes, correct.
that number, that's your office number there?
That's my cell phone number directly.
That's your cell phone. Okay, good. I think I have.
Hey, Russ, so I looked at the messages here. Hui was saying that EXP gives a lot of RSU stock. Okay. So that's one of those things that definitely will help out this group right here, because you have RSUs already. That's huge. And then another question I wanted to ask you, Russ, because I know why collateralize it with life insurance, right? With permanent life insurance is because most people, the cost of buying permanent life insurance versus the cost that you're going to pay for it is very minimal, right, Russ? So if you can explain that.
So typically, great question, Manny. And the concept is that when you can buy permanent life insurance, it's pennies on the dollar. So let's say it's 10 cents on the dollar to make it simple for collateral. And again, the structure is going to be designed as specific to your dynamic. So based on the person's time frame, what they're doing, when they plan on stopping working, whatever the situation may be. Typically, I try to structure the plan so that I pay them in 10 years, or I have you pay them in 10 years. And then after the 10th year, you don't have to make any more payments towards the insurance. But having permanent value life insurance also gives you access to the cash accumulation, which is just another vehicle that we can help you get into. And I can get into the weeds real quickly here with a lot of this. But if you think about it in relationship, if you could go out there today, Jeff, and buy a house, and it was a $2 million house, and you could give them $200,000 to go buy the house, you probably wouldn't have to think too long, would you?
Right.
Well, that's exactly what we're doing here. Now, sometimes it's a little bit more than 10 cents on the dollar, but statistically speaking, It's 10 cents or less for a full exchange, because a permanent life insurance policy acts as full collateral. And the way we do it is 2.5 to 1. So if I take out 100,000, I assign 250,000 of the death benefit. This way you never have to pay back any interest in your lifetime.
That's good. We had another
Thank,
question here from Keel. It said, how would you transfer current rental properties into a structure like this?
great
Okay.
question.
Great question. So one of the things that we'll do with that is typically we can transfer your interest into it based on that. If we actually transfer the property in, see, we're trying to typically keep the properties outside so you can still appreciate the depreciation like you're getting on your properties now. See, anything that's a growth or a reduction standpoint on the outside, depreciation, whatever the scenario is, you can still keep on the outside of the LLC. You're basically transferring your ownership interest into the LLC, because this is tremendous for passive income, okay? Because we can eliminate the passive income because you're only being taxed on 2%. So this way you still get the deductions, you still get the depreciation, and now the income that's coming in, you're only being taxed on 2% on the growth of that income, which is huge, okay? But transferring documents is basically transferring into an LLC or whatever. If you're donating, every situation is going to be different. That's why we break them out individually, but we do it all the time for real estate, especially because there's commercial entities, there's individual entities, whatever's going on inside that. But sometimes we'll talk to you about creating a different trust or whatever as well. But we're going to do based on what you're trying to accomplish. So it's going to be specific to your individualization. Okay. The other thing I just want to talk about on depreciation, everybody's in real estate loves depreciation. I mean, that's why they buy real estate most of it. They depreciate. Well, what happens, Jeff, if you went out and bought a house, let's say for $1 million, and you depreciated it and you decided to sell the house in 3 years? Okay. What is that term called? Do you know what that's called when you go to sell a house and you've depreciated part of the value?
I do not.
It's called recapture. Okay. The IRS doesn't let you get away with anything. All right.
Right.
So if you depreciate it, they're going to get it back through the sale. Okay. So inside this, we mitigate that. You eliminate that whole concept.
So no more kicking the can down the road.
No more kicking, yeah. So again, certain applications, DSTs, deferred sales trust, are phenomenal vehicles, and we can get those set up for you as well. Those are much more involved, much more structured. See, a lot of people, if you knew anything about estate or heard anything about it, there's things that you might have heard out there called the charitable remainder trust. Charitable remainder trusts have been used for years in the law, and what they were is they're a great way for people to donate assets to them while they're alive so they can get the tax deduction now. Problem is when they put the money into the charitable remainder trust, as the money's locked up, they may get an annuity distribution based on their age or something, but their money gets locked up, they don't have access to it. This is like having your cake and eating it too, because you put the money in technically on Monday, you could take it out on Tuesday with no restrictions, no paperwork, other than you simply, and that's why I said if you set it up in Chase in your example, if you put $100,000 on Monday, you could take $100,000 out on Tuesday, okay, and use the money for whatever the heck you want. There is no restrictions.
Yeah, that's very interesting, man. Man, mine's a little bit different with my trust, but
Yes.
again, like you were saying, it's some more of a deferment.
Yes.
And then the kids, if they don't know what they're doing, they're just going to hit with a big, huge tax bill.
Huge.
It's a big problem for a lot of people. See, and a lot of people, honestly, Jeff, are like you, that let's set up something because someone showed them something that made sense. This is transitional, so even if something were to happen to you, we start telling you, listen, let's put your children, once they become of age, we're going to start educating them so that they become part of a member of this particular LLC. They're on it, so this way they can just take over when something were to happen to you, where you said, listen, let's do this. Now remember, all that money that value stays inside that LLC account. Now you could have borrowed it all out and spent it. That's your choice if that's what you did. But because it was collateralized, then there's no problem with that. But if you think about it, where else can you put money today and only pay tax on 2% of the earnings? And so let's call it worst case scenario. 2% on the earnings, you're only paying tax on 2%. You're not paying 2% on the earnings, you're paying tax on 2% of the earnings. So on $1 million, if you made 10%, 100,000, you're only paying tax on 20 grand.
Wow, yeah.
So 20 grand at your current tax rate, so you're paying 30%, $6,000. All right. Big difference between making $1 million and having to pay 35% on that same $1 million, that's 35 grand or 350,000. So
Right.
the concept is there's relative terms. So we want to make sure we're talking about your dynamic and your special situation inside your family. So we're creating legacy. But to me, if I can show you how to have the government fund your retirement, how ironic is that?
Right. Yeah.
Because they're trying to take all your money away. Because everyone thinks of the traditional methods. I'm going to put money into a 401k. I'm going to have an IRA. You got a lot of 1099 contractors. I'm going to have a SEP IRA. I'm going to have a simple IRA. I'm going to do different things because I'm going to put it away because I'm trying to get a tax deduction. And that's why people do it, because they're trying to get the tax deduction. Usually they don't say, well, I'm looking to put money away for retirement. They're trying to save taxes today.
Mhm.
Well, what do you think is going to happen with taxes, Jeff? Do you think our taxes are going down in the future or they're going up?
They're going up.
They're going up. In 2026, they're already going up. All right. It's already on the books. All right. The top tax bracket's going 39.5%. So I mean, that's a lot of money. And that's just on the federal level. If you live in certain states, California, New York, some of these other states, these people are paying 51, 52% tax between state and federal.
Yeah, that's crazy.
Do you want to keep 48 cents on a dollar? I don't.
And I got a question, Russ. One more. I know you talked about disinherit. You don't disinherit your family, right? I think that's a huge thing because let's say you did have that $5 million policy and you only used $1 million of it for the purposes of saving on taxes, right? What happens to that other $4 million, Russ?
Anything above and beyond that has not been assigned will go to your family because you still own the policy. The LLC doesn't own the policy. You do as the individual. So if, let's say, that case did happen, and I'll pick on Jeff again because he's the one I was talking to.
Yeah.
Let's say he passed away. He had borrowed $1 million out of the LLC that he had put in. So they have the option at that point when if he were to die, what I would suggest, and if it was a $5 million policy, that we would contact the accountant. He would run whatever the total of the loan was plus the interest that had been accrued up to that point. Let's say it's $1.5 million.
Mhm.
Well, they would put 1.5 million back into the LLC, which they're putting it in the LLC, right? Because they don't have to send it to the charity yet. It just has to be whole. They put the $1.5 million in on Monday. They could take the $1.5 million out on Tuesday because it's back in the LLC, but the debt has been paid.
Yeah, right.
Okay? And the additional $3.5 million in this example went to your family as a beneficiary.
Tax-free.
Tax-free.
That's good.
Tax-free.
So you're going to get a common theme in the things I start talking about. It's tax-free, tax
Right.
mitigation. All right. Take it away from the IRS, reverse engineer. But again, everything that I do is all about legacy planning. Okay. I'm all for saving money, but I want you to repurpose the money the right way, and I want it to do to protect your family. That's what I want. How you want it to protect them is your choice, but it's not, we don't use money as a measuring stick. Okay. I use money, what it's designed for. It's a tool. And let's position yourself in a better place, and let's give yourself and help you create generational wealth. That's what our mission is.
Yeah, that's great. That's what our team, I mean, that's what our mission is at Team Legacy, is creating wealth, creating generational wealth. So this has been great
Yes, sir.
information. Does anybody have any questions before we jump off here? So I heard somebody. Maybe I didn't. No? Okay. Well, yeah, you guys can reach out to Russ and Manny anytime. That's their phone number there. Their website, thebestfinancialpartners.com, and then Russ at bestfp.net. I'm going to stop the recording here, and you can stop sharing your screen if you'd like.